Welcome to Talking Property. Today I'm joined by Australia's best property analyst, Louis Christopher, and we're going to take a deep dive into what the next 12 months brings for the Sydney property market. Louis, thanks as always for joining us.
Nice to be with you once again, Peter.
Louis, when we catch up at this time of year normally, we ask you in this segment to take a look at what the Sydney property market's going to do between July and Christmas.
Yes.
Given the magnitude of events and what is happening in the world that we live in, I just want to go a little bit further this year and get your view. I'm not asking you or nailing you down on any forecast, but get your view and take a look at what's likely to determine the Sydney property market over the next 12 months rather than the next 6. I think for anyone that is looking to trade, taking a slightly longer view is probably, they're going to be better off by doing so rather than transacting in the moment, if you like. What do you see happening over the next 12 months, Louis?
Okay, so firstly, for this current calendar year, we have an official forecast out there, and that is that Sydney housing prices will fall for this calendar year compared to 2025 of somewhere between 7 to 9%. That's now that was revised, as you recall, with your audience back in November 2025. We were initially forecasting very slow, low single-digit growth for Sydney. But of course, events changed all that. And so we had to revise our forecasts. And we did quickly revise our forecasts on the outbreak of the Middle East war and then revise them again on the news of the property taxation changes. Unfortunately, in forecasting, Peter, these X factors that come along, you can't always predict them, but what you should do as a forecaster is take them into account and let your audience be aware of a revised thinking that you've got based on events which have occurred that were not foreseen.
Look, I agree, and I see on social media people will look at a forecast that someone's had, in simple terms on the 1st of January and try and beat them over the head in December because they got it wrong. But we're always subject to events.
We're always subject to events. Now, we do scenarios. Look, I think so long as forecasters are transparent and they come out with a revision and make it clear that it's a revision. Unfortunately, some of the banks don't do it this way. They come out as though like this is a new forecast when all they've done is just a simple revision. So I don't appreciate how some do this disingenuously. But this is the reality. We need to do events, and that's the reason why I do scenario forecasting, to try and take into account some of the possible events out there in the market. And so when we think forward to your question, next 12 months from here, from mid-year 2026 to mid-year 2027, what can we expect? What are some of the driving forces? Firstly, we will have this adjustment due to the property taxation changes continue. Rental yields will continue to rise, but it will be ongoing beyond the next 12 months. In our view, keeping everything else equal, we expect this adjustment period to last somewhere north of 2 years, maybe 2 to 3 years. Everything else will not be equal. I can assure you something's going to change over that time frame, whether it's a rise in interest rates or a fall in interest rates, the end of a war, the beginning of a war, the announcement of aliens, who knows, right? Yet something is going to change. There's going to be an X factor. So let's think about the possible X factors that are out there.
We'll work through them. We'll come up with our market headwinds on our first slide here, if you like. Geopolitically, what do you see happening there?
I see tensions continue in the Middle East like they always have, but they've simmered down a little bit of late. Interestingly, oil prices have really fallen. We're now back to levels recorded prior to the outbreak of the Middle East war. This is an important point, Peter, in my view, because the driver of this potential new outbreak of inflation was a rise in energy prices driven by big rises in oil prices. Oil prices did go up. There were concerns about shortages, and we briefly had some. But since essentially the month of May, oil prices have settled and have been more recently coming way off back to where we are now. That'll have an impact upon our headline CPI eventually, Peter. And I think we can expect a lower annual read on the CPI as we head towards the last quarter of 2026. This may well then have ramifications for interest rates.
Yes, indeed.
Probabilities of an interest rate cut have been actually rising, more so than, say, another interest rate rise. Now, I don't think an interest rate cut's coming anytime soon, but could we get an interest rate cut sometime, say, late this year or in 2027? Yeah, we could.
Do you see any further hikes? Like, if you read that last statement, what did you make about the RBA's June 22 statement?
Central bank was still pretty hawkish.
Yes.
They did flag that the economy was slowing down. And of course, their mandate is to try and, as best they possibly can, keep a stable economy with full employment. If we get another bad read on unemployment, we're going to be starting to talk about a material economic slowdown occurring in this country.
Yeah, well, that is one of our headwinds as we see it heading into 2027. Is unemployment continues to rise.
Yeah.
Did we jump from 4.1 to 4.5? Or
Yes, we did.
Yeah, just in one month, and we're
That's
waiting
right.
for the next number.
And this is interesting because people are not aware that when you go into a real economic slowdown, like for example the 1990 recession, back in the 1990 recession, unemployment went from about 5% to about 9% in the space of about 7 months.
Wow.
Like it happened really quickly.
Are you
And
seeing the same sorts of things in this economy?
I'm definitely seeing job losses.
Yes.
Driven in part by AI, driven in part by the lack of confidence in the economy. Remember, consumer sentiment is like at 1990
It's in the
lows.
toilet.
It's as bad as what it was in 1990.
Yeah.
There is a risk of a contraction in the economy. For the March quarter, we grew at just 0.3%, and on a per capita basis, we went backwards. Not the first time we've been going backwards on a per capita basis, but we only grew by 0.3%. When the June quarter read comes out, that'll take into account the full effects of the Middle East war, the rises we had, the plummeting in confidence, the fall in housing prices. I wouldn't be surprised if for the June quarter we record a contraction.
Which sets up a potential recession scenario if things don't turn around from there.
And that will be playing on the RBA's mind. And I'm sure we've said this in previous discussions. When you have a situation of stagflation,
Oh yes, we have discussed inflation, yeah.
central banks are cornered. They're cornered. They're damned if they do, they're damned if they do. And they don't. It's a very hard position to be in terms of trying to set monetary policy. But if you also take the view, okay, oil prices are coming down, that's going to perhaps stabilise the CPI in time, the RBA may well then have amplitude to cut rates.
Yeah, so let's take a look at some of the tailwinds coming in to 2027, and this is why today we wanted to take a 12-month view of things rather than 6 months, because what you've outlined there is if we do start seriously hitting the rocks, the RBA, and this is a big point, the RBA have now given themselves scope and room to move, haven't they?
Yeah, they have. That's
by way of cutting
That's
rates.
exactly right. And what is also interesting, okay, we have a cash rate of 4.35%. That is equal to the last peak that we had with interest rate settings when interest rates were risen in 2023.
That's right, yes.
So I think, and the Reserve Bank got a bit of a slowdown in the economy as a result of those interest rate rises. So they'll be aware of that. They'll be conscious of that was a point last time where they achieved what they wanted to achieve. I think the probabilities have increased that the RBA may stay on pause for now, and the probabilities have increased that perhaps later this year and in 2027 we'll see a rate cut. Now, what could throw all that away? CPI just keeps on rising. That there's been a major multiplier effect due to the energy prices into food prices, into rents. We know rents are still rising. And into
You're talking
other
residential rents there, aren't
residential
you?
rents.
Because they form part of the CPI basket.
Correct.
Yeah.
Electricity prices, of course. So the here and now is that there's still upward pressure on the CPI.
Of the things you've just mentioned there, I think electricity is the one that's most likely to continue driving inflation, isn't it?
Yeah.
Energy.
Yeah. Housing costs as well. Rents, of course, feed into the housing cost bucket along with construction costs, which have still been rising. And then, of course, you've been having some big wage rises in the public services sector, as well as the affordable end, for lack of better words, of the employment market.
Yeah. Just on employment, I saw Warren Hogan speak straight after the budget.
Yeah.
Noted economist, and he, which was really interesting, and he gave his view on the budget. But when it came to employment, he had a view that we won't see a sharp rise in unemployment. What his view with employment was, and I'm keen for your take on this, is that we need to retrain our workforce. It's not that we have too many workers for the economy at large. It's that people are not trained for the jobs that are out there or wanting to do the jobs that are out there. What's your view on that?
Well, there is a shortage of workers over on the construction side, so
Yes.
we know that. And in part, the migration policies that we have had have failed. They were meant to increase, reduce the pressure on skilled shortages. Hasn't happened.
So we've seen too many people run into banking and IT.
Yeah. Look, on the AI front, I think there is job creation opportunities there, but it's also the case that there have been job losses. More so, the biggest impact upon unemployment is the consumer confidence numbers. Are people spending in the shops? And we all know right now confidence is at a very low ebb. So I'm not in the camp of Warren Hogan thinking, look, unemployment won't rise much further. I think unless interest rates are cut, there's more stimulus in the economy, I think it will rise.
It's hard to see where new housing en masse is going to come from in the short term. Do you think the limited new supply will help support property prices and potentially set up the next, I won't call it a boom, but the next growth cycle?
Yeah, look, there's been increasing discussion of a possible housing price crash. I don't think what we're in is a housing price crash. It's not to say it's not a meaningful correction, it is. We're missing one key ingredient for a housing price crash to happen, and that is we do not have a surplus of properties out there. It shows up in the rental vacancy rates. When you look at Japan, when you look at Ireland, when you look at the United States, they all exhibited one major ingredient, and that was that there was speculative building beforehand, before the crash. Yeah. And that's what toppled the market in many respects, along with interest rate rises.
You could probably throw China in there now. Their property market's under severe pressure.
Exactly.
Evergrande collapsed, ghost cities.
Along with demographic changes. I mean, the US housing price boom and then crash. In all that, you didn't see very strong population growth in the United States. You saw a lot of building growth, a lot of loose lending, of course, caused that calamity. In China, of course, they're having now negative population. And of course, we all know with the Japanese bubble and bust, that was a combination of speculative lending, once again, strong building, but then a demographic change where their population went backwards. Now, to that point, I'll give you another scenario for us to all consider. Let's consider for a moment one nation wins federal government, and they bring in the harder migration changes that they've put forward. So that is, they want to cut migration down to 130,000 a year. And that means that total population expansion would be somewhere along the lines of 230,000 from just shy of 500,000 we've got now. If that were to happen, and at the same time they bring in negative gearing and you get a building boom, there is a risk that if those policy changes happen quickly and aggressively, we could have another round of housing price falls. If you see a rise in supply, a relative fall in underlying demand to supply, which does increase affordable housing, but you could see housing price falls in that scenario.
Look, I know when we spoke a couple of weeks ago off air, another stat that Warren Hogan rolled out further to that point, which you were not surprised about and probably already knew, but I think a lot of people would be surprised about, is the immigration rate into Australia is higher than the natural birth rate.
Oh, it is, by a long shot.
We by a long shot. To what degree, Louis?
It's by like 3 to 1.
3 to 1.
Yeah.
So we're importing, or
well, it used to be up to 5 to 1, and then things have slowed down a little bit, but yeah, it's still minimum 3 to 1.
How do you think the Australian nation, feel about that?
Well, they're pissed off about it, quite frankly.
Yes.
A lot of people are.
We're not the only country doing it either, are we?
In terms of OECD countries, we've had the highest proportion of migration intake compared to population growth in many respects. So it's, Europe's had, of course, an increase in migration, which they've been scaling back of late. We haven't been really scaling back materially. It has come off from its peaks, but it's still well above the pre-COVID numbers.
Now, changing tact, the opposition leader, Angus Taylor,
Yeah.
says that if he is elected, and not, you've outlined a scenario there if Pauline was elected,
Yeah.
but Angus Taylor is saying that if the coalition are elected and in government, they will effectively rip up the budget and,
Yeah.
and reverse it.
Yep.
Is that easier said than done, or is that a plausible scenario? How
Depends what happens in the
practical?
Senate, doesn't it?
Well, it's going to pass because the Greens and
Oh,
Labor...
it'll pass, but
Yeah.
let's assume that, okay, One Nation get up, or the Libs win the next
Yes.
election. Okay, so we know that these property taxation changes are going to pass the Senate. So it's all about the Senate. So the next election, who's going to control the Senate? So, okay, if you have One Nation saying they're going to reverse course with the property taxation changes, you get the Liberal National Party saying the same thing. That's fine. What's going to happen in the Senate? Because if they don't have control of the Senate, if the harder left still have control of the Senate, these things won't pass. Their amendments, their repeals will not get through.
What do you see happening?
Oh, I don't know. You're the political expert over me, mate.
Louis, the government's been its own worst enemy when it comes to spending and creating inflation in the economy. The NDIS has been the big, target for those that are saying you need to get this program under control.
Yeah.
One of the things that I think a lot of people are not as conscious of is certain states, Victoria because they're heading towards an election and WA because they're running a surplus, have got excess spending happening. Are we seeing any evidence that governments are cutting back to help reduce the inflation problem?
I think there is a notion of wishing to cut back, but certainly with the state governments and the recent property taxation changes, they've got a major revenue problem on their hands right now. So we know stamp duty revenues, which is a huge component of the revenue intake for every state government, is going to come back at a rate of knots for FY27. My view is we're going to see property sales turnover fall somewhere between 20 to 30%. And I'll be interested in hearing what you're seeing on the ground if you think sales turnover is going to fall by that type of level compared to, say, FY26.
Oh, look, that's a really interesting point that you raised, because what we're seeing in the real estate industry at the moment is we're seeing certain agents whose sales volumes are going up, not prices, but they're selling more than they've ever sold at the moment.
But that's not showing up in the auction clearance rates.
But then there's other agents, competitors that I'm looking at, and I've never seen them sell so few.
Yeah.
Now, one of the things that I've been advising my clients is the auction clearance rate should not be used as the sole determinant of the market performance, because a lot of the properties that are failing at auction are going on to sell afterwards, is my sense. And our own sales volumes in the last 4 months through this period of upheaval, sales volumes have gone up for us, which has been a bit of a pleasant surprise.
Maybe you're just a good salesman, Peter, and your team, which they are. I do believe sales volume is going to fall overall.
You're seeing the data.
I'm seeing the data.
So you would know.
And we're also seeing a big rise in old listings.
Yes.
So going back to the point, all the way back to government expenditure, the point being on this is that the revenue side for each of the state governments is going to take a big hit. And I see now that they're finally adjusting. I think on the expenditure side, I was very disappointed that the deal was done with the Greens, where essentially a review of the National Disability Affordability Scheme was going to basically delay cuts that need to be done there. And that tells me that, is the federal government really serious about cutting expenditure? When it comes to macroeconomy issues, I'm a little bit more of a libertarian, and I believe that government spending needs to be reined in.
Can we also highlight that we're not against helping people in need?
No,
because I hold the same view. We're talking about the rorts here.
We're talking about the rorts, but the rorts have just gone out of control.
Oh, absolutely they have.
And so there is a meaningful saving to be had if the government can get on top of the rorts.
It beggars belief that they haven't been tougher and stronger and more earnest in this space.
Correct, and it's a worry. Yeah. It's like you've got to ask yourself, well, why? But nevertheless, government expenditure as a proportion of GDP has been rising and rising and rising in this country. So in other words, government as a slice of the overall economic pie has been taking more of our tax dollars. And these property taxation changes reflect that. And they've been spending more. And I argue that government as an entity, whether it's Labor or Liberal or whoever else, is a bit of an inefficient entity. And so in an ideal world, you want the private sector, you want the community to take charge of their own expenditure, of their own output, rather than government doing it for them, because government's an inefficient entity.
On that point, New South Wales Treasurer Daniel Mookhey gets a bit of a tick in today's Financial Review. He did his budget yesterday at the time of recording, and on the home page here of the Fin Review, as you can see, New South Wales Treasurer Daniel Mookhey is doing a better job at containing spending than other governments and helping to fight inflation. So that's a big tick for him, isn't it?
You would know this. So tell me, the Labor government, the state Labor government, the managers of the state Labor government, are they from the right faction of the Labor Party or from the left, or is it a mix?
I would say right.
They are. Well, that might explain it a bit more then.
And I think if you speak to most non-political people but who know what's going on, they will say a right-wing government performs best when it leans into the left. Think Gladys. And they will think a left-wing government performs best when it leans into the right. Think Hawke Keating and what you're seeing now in New South Wales, where if a election were held tomorrow, you would think that the Labor government would be returned.
State Labor government would get it. Well, the election in New South Wales is 2027. But nevertheless, going to this point, New South Wales may be doing better than, say, the national average in containing spending. Federal Labor not doing as well. No question about that. And there are ramifications for the economy in terms of productivity as a result. But it is interesting, the budget came out because I noted they've now flagged that they're going to see a revenue shortfall on stamp duty revenues. And a few weeks back, I did make that publicly known that this would be an outcome. And the State Treasurer kind of shot me down over that point at the time. So I'm glad to see he's changed his tune.
It was good when he gave the grab to the 6 o'clock news, but it didn't stand up to reality in a very short time frame.
No, it did not.
Yeah. Louis, the public have been hit with mixed messages at the moment about what the next move in interest rates might be. If you look at our next two slides here, on the one hand, you've got major banks starting to tweak their longer-term interest rates down, and then when you look at the RBA statement on June 22 after their last meeting, there was a sense from that statement that they might need to dial rates up. What do we make of this? Are we a chance of seeing another quick rate hike to really break the inflation, then they start cutting? Where do you see interest rates over the next 12 months?
There is a risk of a short-term interest rate rise, but as mentioned before, the probabilities have increased of an interest rate cut later in the year and into 2027, driven by potentially a contracting economy.
So the RBA would be fully attuned to all of this, and they wouldn't want to give people a sense there's rate cuts coming prematurely, because they probably regret particularly that third cut in 2025,
Yeah, that is correct. So they will want to still have the message out there, and they might do this by jawboning from here on, that the inflation is still too high, and they need to get it down. We need to get it down. But just merely the threat of another interest rate rise might do the job. And indeed, we know, as we've discussed, there's been a collapse in consumer confidence.
Any jawboning from the RBA here would be extremely effective, because the market is on tilt, isn't it? The economy's on tilt.
Absolutely.
Now, to that point, the RBA have said property prices are not their problem. It's not their remit. We're here to manage price stability and the employment rate in the economy, and house prices are well down the list. But it's a big issue.
Funnily enough, though, they sure seem to talk about housing a lot.
They certainly do. So that's why I wanted to come to this today. This is, by Sydney standards, and certainly by Melbourne's historical standards, this is a nasty downturn. Is it a technical correction or a crash? I'll leave that to others to decide. But this is nasty, and the foreseeable future suggests it's going to get a lot tougher. When and if do the RBA become concerned about what's happening in the housing market and act accordingly, or will they be, completely dismissive of any price action in the property market?
What they'll likely do is they'll frame it in a way in terms of how housing's impacting upon the economy, which is where they need to set monetary policy. So this is how they're going to frame it. And so they'll frame it saying, okay, there's been a big fall in housing construction, which is causing a rise in job losses, as an example.
So they'll try and link it back to their
They'll link it back to the economy.
Yeah.
They've always been cautious about trying to link particularly interest rate rise or cut due to what's going on with the housing market. Notwithstanding, if I recall back in 2002, Ian Macfarlane did precisely that.
He intervened in a big way in his commentary, didn't he?
He intervened in a big way. He talked about the housing bubble, the housing boom that we're having from 2001, and he was lifting interest rates accordingly.
Louis, here we are, July 2026. We sit down with you July 2027. What do you think you'll be telling us the last 12 months brought at that point in time?
More turmoil in the housing market, but a bit of a settling of the shock and awe. The adjustment still occurring, ongoing rises in rents, but investors being offered a higher rental yields, which will start encouraging them to come back into the market.
Oh, great. So 12 months' time, you think we'll be closer to positively or neutrally geared properties that
we'll be closer to equilibrium in the market, and some of the shock and awe will be gone.
Now, spelling it out for our audience, when you talk about closer to equilibrium, you can get there three ways: higher rents, falling prices, or a bit of both. Which do you see happening?
Definitely a bit of both.
Yes, okay.
And at the moment, it's more so on the housing price falls front than rises in rents. So we are getting rises in rents. Don't mistake me there. But yeah, it's for now. It's on. Certainly the news has been on the falls in housing prices.
And politically speaking, I don't want to put you on the spot here, but the government have shown no sense of listening to the outrage about their budget. Do you think they've got the fortitude when the backbench start chirping to go shoulder to the wheel and hold the line for the next 12 months on this budget and the measures?
Peter, I think it's interesting that we're now getting the housing minister and Tanya Plibersek, the old housing minister back in 2009, talk more and more about housing prices and the corrections and trying to defend it and trying not to link it to the property taxation changes. To me, that's a sign that the government could be starting to crack.
Yeah.
And that the pressure is well and truly on them. And I still don't think the government's going to change tune. And once this passes the House, it'll be harder to reverse it because the Greens may well block any type of reversal. But let's just remember Keating did reverse course on the negative gearing changes when it was obvious that it was causing acceleration in rents.
Have we got a sense in anything that's been leaked or released, have we got a sense of whether this was, and it rarely is, this was a joint decision by Albanese and Chalmers, or has one sort of imposed themselves over the other to get this budget through?
I don't know. But what I do know, Peter, is that it's been on Labor's agenda for negative gearing changes since at least the 2016
So it's in
election.
their DNA?
It's been in their DNA for at least the last 10 years now.
If you had to make a call now, does Anthony Albanese contest the next election or step aside?
I don't know what he's going to do. All I know is
he can't be overthrown.
Yeah, it's very hard, isn't it?
Yeah.
It's very hard for a Labor Prime Minister now to be overthrown. So, look, if I was having a betting man, he'll go down with a sinking ship.
If I was a betting man, which I'm prone to do at times, I would say he's going to step aside.
Oh, well, there you go.
Yeah.
We'll see what happens. We've got 2 years until the next election.
He saw his good mate Keir Starmer squeezed out this week.
That's true. There is a chance, and maybe there'll be people tapping on his shoulder saying, do you really want one nation to lead this country? Is that what you want? Because that's what's going to happen.
And that's what you're seeing. You're seeing one nation.
Yeah, that's correct. Now, I have my own views on what a one nation government would look like, and I take the view it won't be a very disciplined government, and then you probably would see then a swing back to the Liberal National Party. Yeah. That's a long-term view, but we'll see.
They say the betting market's up in many ways more accurate than polls. For those that are interested, as it stands, to be the Prime Minister after the next election, Anthony Albanese is $1.80.
Yeah.
Angus Taylor's $8.50.
Yeah.
And Pauline's somewhere in the mid-3s. So remarkable times.
Oh, remarkable times indeed.
Yeah, indeed. Louis, outstanding wrap on what's coming up in the next 12 months, and we look forward to speaking with you next time.
Looking forward to it.